Hey guys, it's Cody here, and this week we're going to be talking about incorporating. So, why would someone want to incorporate in the first place? When would it make sense for them to consider incorporating? Are there other strategies that could help attain the same goal that we have as incorporating by using personal tax shelters like RRSPs or TFSAs? And I guess what benefits come with incorporating? Like, why would someone want to do it in the first place? What are the real benefits that they're going to see from that as a business owner or as a registered professional in a certain trade. And I hope that it all makes sense to you. I throw a lot of numbers out there. If you have any questions for me personally, I'd be glad to sit down and talk to you with it just through a little bit of research that I've done. And I'd be happy to hear your comments on it too. Let's go. My name is Cody Kraus, and I'm a real estate broker owner that's obsessed with everything real estate. Investing, building, selling, developing, farming, you name it. I've been doing this since I was 18 years old, and I've learned a ton through trial and error, and I've met some of the coolest people ever. This is a show where I invite these people on to talk about their experiences and mine, plus everything else real estate. Let's go. Well, welcome back, everybody, to the Everything Real Estate Show. Today I have no guest. But I'm going to share with you guys what I think you're going to find as an interesting, discussion anyways, a discussion I'm having with myself maybe. But the conversation is around incorporating. And I speak to a lot of realtors, so a lot of what we talk about is personally incorporating or professionally incorporating as a realtor. But I want to have a more broad discussion, which is just incorporating in general. So I guess a couple questions that I want to seek to answer, and I'd love to get feedback from you on this also, audience, is why would someone want to incorporate in the first place? And when would it make sense for someone or for a business to incorporate? And I'm hoping that I can answer some of those questions for you. So first off, I would say that the biggest reason that a lot of people would seek to incorporate is for tax purposes. There was a Fraser Institute report that came out just recently, and it said that 42% of the average Canadian household is spent on taxes each year. Now, you compare that to housing, food, and clothing all combined together at just over 35%, 35.5%. It's crazy to think that we spend, over 40% of our income on taxes. So, right off the top, a reason that a lot of people would consider incorporating their business is for saving on taxes. Now, how exactly would incorporating help you save on taxes? Well, just for context, in 2025, the first $500,000 of income in a corporation in Ontario is taxed at 12.2%. Comparatively, if you're at the highest marginal tax rate personally in Ontario, you're at a tax rate of 53.5%. And I have an example here for you. So if you make $250,000 as a person, not incorporated, you would pay just shy of $100,000 in personal income tax in that calendar year. Now, that doesn't include taxes that you pay for everything else, like property tax or HST, sales tax on goods that you purchase or services, um, carbon tax, whatever. We pay tax on a lot of things, but just income tax in Ontario, Canada, so if your provincial and federal portion, total on $250,000 net income would be almost $100,000 in taxes, leaving you with only 150 after earning 250,000. Now, what would it look like if your corporation brought in $250,000? Well, your corporation would pay that 12.2% tax, totaling $30,500. So there'd be 219,500 or just shy of 220 left over in the corporation. Now, let's say that you dividend yourself 100,000 because maybe your business brought in 250,000, but your household doesn't require you to earn that whole 250. And so maybe you're able to leave some inside the corporation. Um, you would dividend yourself 100,000 of that approximately 220,000. You'd be able to keep just shy of 120,000 cash in your bank account. And if you pay yourself $100,000 dividend income, you would pay just over $16,000 in personal income tax. So in one scenario, you earn $250,000 and you're taxed $100,000, leaving you with approximately $150,000 net. In the other scenario, 250 comes into the corp. You dividend yourself 100. You pay $30,500 in corporate taxes. You're left with 120 in the corp, and after you pay $16,000 personal income tax on that $100,000 dividend, you still have $83,000 net. So the total retained dollar between your corporation and your person put together is $203,000, where the total retained dollar, where you just claim it all personally, is just over $150,000. So in this scenario, on $250,000 of income, where you only dividend yourself 100, your total tax deferral would be $52,499. So that's the benefit. And so if people don't quite understand what incorporating is or why someone would want to incorporate, think of a corporation like another person. Um, and so if I just create another person and that person earns an income and then that person pays me part of that income because I don't need the full amount, but I want them to maintain some of that cash. Um, they pay their own tax rate, I pay my own tax rate. So it's another entity is essentially what it is. So that's one reason that you would want to incorporate is to temporarily defer some taxes. Now, I'll tell you why I incorporated my first company. It was because I started buying rental properties and I hit a wall. And the wall was that the bank that I was financing properties through said, we can only extend to you a maximum of 5 residential mortgages. And then after that, you're cut off. So either I would have to go to another bank that would have a higher policy limit, but most are lower, to be honest with you. But also, eventually, I'm going to run out of income. So when you get rental income from a property, you have to, you can claim it as income, but then you also have to offset the expenses. So let's say that I have a rental property that brings in $1,000 per month. A lot of banks allow you to use 50 to 80% of that $1,000. So $500 to $800 per month would go towards servicing the debt. So therefore, I would still need additional income up and above my personal debts in my life. So maybe my mortgage, or if I had a student loan or a car loan, they look at the total indebtedness of the person, and if they've already extended me too much credit, then they would not allow for me to continue buying rental properties because I need to cover a portion of that. So they're not stupid and they know that rental properties have vacancy from time to time and that they require maintenance. So they don't allow you to use 100% of the rents to offset the costs of ownership. So therefore, if I want to keep buying properties, eventually I'm either going to be limited by my bank's lending policy or my own income not being high enough to keep buying property. Okay, so what's the way around this? Well, then the next route is commercial. Okay, well, if I incorporate, then I can get a commercial loan on the property. And with commercial loans, they're typically called a debt service coverage loan or DSCL. And instead of looking at the person, although they still often want a personal guarantee, instead of looking at the person, they look at the asset and the income coming in from the asset and the expenses that are involved in carrying the asset. So if I have a home again that brings in $1,000 a month, um, typically if my expenses are, $750 per month, then they'd have no problem approving me for that mortgage, regardless of how much I make as an individual person, because now it's a commercial loan that's looking at the asset specifically and its ability to offset the expenses of owning the property. And so in that regard, the sky's the limit. You can buy as many properties as you can come up with down payments for, as long as the whole portfolio, and they do look at the portfolio as a whole in commercial, um, meets their debt service coverage ratios that they have as a policy as an institution. Now, typically the rates are slightly higher. That's one downside. Um, they can again require a personal guarantee, which if you were buying the home personally, anyways, in your personal name, not incorporated, then your name's on it anyways, which is the same as a personal guarantee, really. Um, but the benefit, again, being that sky's the limit, go nuts, buy as many as you want. You're just going to be paying a higher interest rate. And the other thing is, it is a passive income stream under CRA's designation. So passive tax inside of a corporation is typically taxed at 50%. So if you made $100,000 a year in passive income on rental properties, 50% of any profits would be taxed. Now, that's very different than the 12.2% corporate income tax we talked about, or corporate tax. But again, that's on active earned income, which is why a lot of realtors are looking to incorporate, or a doctor would incorporate, or an accountant would incorporate, or an engineer would incorporate, or maybe even a trade, a heating and cooling company, a plumber, an electrician. A lot of times they would incorporate because then they're only paying that 12.2%. Now, the benefit there is if I'm earning an income in my business and I'm able to defer some of the taxes by living on less than I make or less than I bring into the company, paying myself a smaller salary or dividend than what the company is making, then the company is able to retain money, and then my purchasing power goes further. So if I was going to buy a $400,000 home, typically the bank is going to want a 20% down payment, maybe 25%, sometimes even 35. But let's say it's 20%, and my other costs of purchasing maybe add up to 5% with land transfer tax, lawyers' fees, maybe appraisals or any other fees involved in the purchase. So let's say that I'm going to buy a $400,000 property and I need to come up with $100,000 for the down payment. Well, if you'll recall in my example there of $250,000 earned, we deferred $52,500 approximately by keeping the money in the corporation and then just dividending my household $100,000. So in theory, if I make $250,000 a year inside the corporation for 2 years and just dividend myself $100,000 each year and have no other expenses, which is unlikely, but just for argument's sake, after 2 years, I would have that $100,000 liquid so that I could go ahead and purchase this investment property. So my dollar is going to go further when I'm paying less tax on the retained dollar at the end of it. The difference in household income there, in one scenario, I was keeping, $150,000 in my household as opposed to 83. But when I'm not incorporated, a lot of my business expenses are going to show up under my household expenses anyways, right? So if you're including your home office or your cell phone or your car expenses, vehicle expenses, internet, uh, printer, office supplies, whatever it may be. So that 150 versus, $83,000 retained, if I was paying myself that $100,000 dividend, there's going to be some expenses that show up under there too, where in the other case, a lot of my expenses are going to show up under the corporation. So those are two reasons right there. I guess deferral of taxes, and then the fact that your money goes further if you're looking to buy assets that you would hold inside of that corporation. Now, I did things backwards. I was talking about the first time I incorporated a company. Um, I incorporated because I was kind of hitting that ceiling where I couldn't buy more property without incorporating. The mistake that I made was getting to that limit first and then incorporating. And the unfortunate thing was I had to pay capital gains. I had to pay for appraisals. I actually had to sell the properties from my person to my corporation, then pay capital gains on the difference there, and pay land transfer and pay lending fees and pay for appraisals. So I incurred tens of thousands of dollars transferring the properties from my person to my corporation. So had I planned this effectively from the start, and if I had said I want to have a portfolio of more than 5 properties, I would have saved a ton of money if I would have just incorporated from the start and then started adding the properties to the portfolio rather than buying the properties personally and then transferring them over to the portfolio. So if you can learn from my mistake there, you will save yourself a ton of money. If your goal is to have a portfolio above 5 residential properties, I would certainly look into incorporating before you start acquiring those properties. Now, when exactly would it be the right time for you to incorporate? So I have a few scenarios, and I would urge you to have this conversation with your accountant, your financial planner, whoever it may be, before you pull the trigger on this. Don't just go on my advice, but having been through this a couple times, the few things I would consider as triggers where, hey, it's probably going to make sense for me to incorporate now. So one is when I want to build that portfolio beyond 5 properties. Second is I'm consistently making a lot of money and I'm living on less than I make. So I want to retain some of the money inside of a corporation and tax shelter some of it. So a general rule of thumb would be when you say for 3 years live on significantly less than you make, it's probably a good idea to consider incorporating it at that point if you're able to. And when I say you're able to, realtors until 2020 actually couldn't personally incorporate. So it does depend on the line of work that you're in and the license that you hold and things like that. Um, Another scenario I would say is if you're in a sales career and you're able to incorporate, if you hit $250,000 of annual gross closing commissions, say 3 years in a row, consistency is key here because if there's ups and downs, there's another way that you can do it without incorporating to try and level the taxes a little bit. Um, and then another scenario I would say is when you're hiring staff or buying life insurance or trying to add a layer of um, safety from a liability standpoint. I don't think this is effective in Canada as it would be in maybe some states or some other countries. It used to be that you would have reduced liability if you owned an asset or a business inside of a corporation, but it's not typically the case from my experience now. Um, if you were to say have a slip and fall lawsuit, it's probably still going to have your name on it or the name of your corporation, but it's going to be addressed to you and good chance that, your registered address is going to be your house and all those kind of things until you grow to a certain level. The reason I say when you're hiring staff is, you know what, if you're incorporated, you have multiple properties coming in and professional stream of income and all that kind of stuff. You're probably going to have a bookkeeper and or an accountant that you're consulting with regularly. They're probably going to handle your payroll. And when you're working with multiple employees, now all of a sudden you have payroll taxes and withholdings and everything like that. I think there's a measure of safety that I get in having all of that inside of a corporate bank account that's not linked to me personally. And then buying life insurance. So, for example, if I have a professional corporation, I can actually buy a whole life policy through my corporation and put it on my person. And then that way I'm using pre-tax dollars or, money that was taxed at 12.2% instead of money that was taxed at, say, 52% or whatever it is. So my dollar is going to go further when I'm buying life insurance, just like it is when I'm buying properties and putting a down payment on them, or if I'm buying another investment like a security or shares in a company or anything like that. Um, so those are a few reasons why you might want to incorporate in the level of production you'd want to get to at that point to consider maybe I should pull the trigger on incorporating. So another thing that you'd probably want to talk to your financial planner and or accountant about is your ability to average your income with RRSPs before you consider incorporating. So if you're kind of at that point where you're like, well, I'm, I feel like it might be beneficial for me to incorporate, but I want to see a few more years of consistency in my performance or income before I pull the trigger on that. Because what I will tell you is that it's typically going to cost you somewhere from $2,000 to $5,000 to incorporate, and on an annual basis, just between financial filings and your annual uh, minute and shareholders book with your between your accountant and your lawyer, you're probably going to incur about $5,000 to $6,000 in professional fees on the minimum on an annual basis. So again, unless you're living on substantially less than you're bringing into your company or into your household, there's not going to be a whole lot of benefit to incorporating because, yeah, you're going to dodge some taxes on the way in, but if you're paying it all out in salary or dividends, Well, now we don't really have any savings because we're paying the corporate tax rate on anything held within, but then we also have expenses that are in the amount of, $5,000, $6,000 plus per year just to keep that corporation alive. So what's another way that we could, look at bridging the gap until we get to that point where we're ready to pull the trigger on incorporating? And that's the use of RRSPs. And I've had a financial planner explain this to me, Carmelo. We've had him on the podcast. And he suggested that some people, if they have contribution room in their RRSP, that it would actually make sense many times for them to earn the big income and max out their RSP contribution so that they still have room to live off of, obviously. But if we were going to retain 150,000 of that 250,000 in our corporation, in theory, if we were looking at incorporating, instead, what we could do is max our RSP contribution and then dodge the income taxes by putting all that money into the RSP. Now, if we have a low year in sales next year or low year in performance next year, we could actually pull some of that RSP out, and then the withdrawal would be taxed at your average tax rate for that year. So you can actually almost use an RSP as a way to flatten the bumps that you might see in a sales career. Because often in a sales career or for a business owner, you're going to see a lot of ups and downs. It's the entrepreneur roller coaster, like Darren Hardy calls it. And so you got to take a look at different tax products or shelters or things that the government has put in place to allow us to average these a little bit. And so the two tax shelters we have in Canada, the big ones are your RSP and your TFSA. Now, the RRSP is dodging income tax on the way in. The growth is free. You're paying the income tax on the way out. The TFSA, you're paying the income tax up front. The growth is free, and then you're not taxed when you pull it out. And there's a few others like the first-time home buyer savings account, and then also the RESP, the Registered Education Savings Plan. But the main two are RSPs and TFSAs. And again, talking about trying to defer some of the income tax on a good year, the RRSP would probably be the most effective in that regard. But you have to have contribution room. And if you had a corporation and you're paying yourself dividend income as opposed to salary income, well, dividend income doesn't give you that buffer. It doesn't give you that contribution room to your RSP. So again, talk all this through with your accountant and your financial planner. But an RSP can be a good way to, I think I want to incorporate, but I want to give it 2 more years to see if I can, have kind of a steady point or consistency at a high level income before I incur all the professional fees at the startup and the ongoing of the corporation. Maybe I can talk with them and look at using my RRSP contribution room for 2 years as a buffer until I get there. And if I end up not needing the corporation, well, then I probably dodged a lot of fees. And if I do end up needing it, well, no harm, no foul. At least you got money in your RRSP now, and that's going to put you in a good place for retirement. So those are a few thoughts I had around why someone would want to incorporate in the first place, when it would make sense for them to incorporate, and the benefits of incorporating a business or incorporating professionally. And there might be some things that I missed. This is just me kind of looking back on again, some of the mistakes that I've made in 2020 as realtors. We got the ability to professionally incorporate, and I took advantage of that pretty quickly. And so I've learned some things along the way with that too. And I just thought I'd share it. And again, this isn't specific to only realtors. Just about any business, like if you're a property manager, if you have a landscaping company, almost any company has the ability to incorporate when it's a license type system like realtor. They don't always have that ability. Financial planners, I know sometimes do, sometimes don't, depending on who they're affiliated with. You got to talk with your license regulator and see if that's an opportunity for you. But anyways, those are a few thoughts that I had. Love to hear some comments and feedback from you guys. And I hope that you all found that valuable. Thanks. Bye for now. Thanks for listening to the show, folks. Please keep in mind that this show is not offering legal, financial, or accounting advice, but rather opinions and experiences in the world of real estate from the host and the guests. If you're enjoying the show, please rate, review, and share with your friends and colleagues. And if you think that there's someone that needs to be on this show, please feel free to connect them with me. Or if there's a topic that should be discussed, feel free to let me know. Thank you so much, and bye for now.